Hey guys, Darren Sugiyama here, CEO and founder of Lionsmark Capital, the most transparent premium financing intermediary firm in the life insurance industry. So you've probably seen my IRA bailout plan, where a client with a $20 million plus net worth that has a $1 million plus IRA is in a position where they don't need these funds for their own personal retirement. And they don't want their kids to get double taxed either, first with estate taxes and then again with income taxes. However, what if a client is not at that estate tax threshold and they want to repurpose those IRA funds into, say, a premium finance life insurance policy for the purposes of generating a tax-free retirement income stream? Most people will consider doing a Roth conversion. Pay the taxes now and then let the Roth value accumulate tax-free, and then also take tax-free retirement income drawdowns. But what if there was a better way to utilize those funds using a premium finance life insurance policy? So in one of the case studies I'll review in today's webinar, the client was in this exact position, and I'll show you a unique premium financing design that accomplished that goal. And then the second case study I'll review, this client was not at the estate tax threshold either. However, they did not need their IRA funds for their own personal retirement. So we repositioned those qualified funds into a premium finance life insurance policy for death benefit purposes. In this case, there was no need to set up an ILIT because their net worth would likely not trigger the 40% in estate tax. So a much simpler design than my traditional IRA bailout plan. In any case, both of these strategies are great for a client that has a minimum of $500,000 in IRA funds, and their net worth is not at that point where they would be subject to estate taxes. So let's go ahead and take a look at these case studies. Okay, so this particular client had a $1.5 million IRA, and what they were looking for was a potential life insurance-based solution wherein they could reposition those IRA funds into something that was more, I'll just say, tax advantaged as opposed to a Roth IRA. So in this particular model, we started showing drawdowns in year 6. And the reason is based off his age, we didn't want to trigger any early withdrawal penalties. So what we did here was we figured out, okay, we reverse engineered the math on this to draw this account down to 0 based on a 6% annual growth rate and a 45.17% top tier tax bracket. This assumes that the client is making $450,000 in earned income at that time they start taking drawdowns, and this client lives in California. So again, based on the $1.5 million starting point and having a $0 end point, and also assuming that 6% annual growth rate, the client could draw down $449,000 in change in years 6 through 10. And assuming a 45.17% top tier tax bracket, that would net $246,000 and change in net drawdown income in years 6 through 10. So that's going to be the budget that we'll use to fund the hybrid premium finance life insurance policy. So let's take a look at the loan model here. Okay, so here's what we're going to do. We're going to use an annual premium of $500,000 on a 10-pay, and the client is going to start borrowing the full $500,000 in annual premium in years 1 through 5. And they are going to accrue the interest. So in the first year, they would expect it to accrue around $24,000 or so. Next year, about $50,000. Next year, $75,000, et cetera, et cetera. And this is always obviously based on a particular borrowing rate. We always stress test and model 3 different borrowing rate environments. This one, we're just using the average prime rate over the last 20 years, which is 4.79%. And again, we have 2 other loan models that we review with the client as well, assuming a much higher borrowing rate. But just for the sake of this model, we'll go with the average prime rate over the last 20 years. If we're going to accrue interest in years 1 through 5, starting in year 6 and going in years 6 through 10, the annual premium remains at $500,000. In this case, the client is going to take that $246,000 and change budget. Again, that's the after-tax income drawdown from their IRA. If we go back to the previous page again, actually drawing down a gross amount of $449,000 and change after 45% and change of taxes. That's where we came up with a $246,000 net value that we're going to fund the life insurance policy. Again, here it is right here, $246,494. So again, if the premium is $500,000, client pays $246,000 of that $500,000, they're going to borrow $253,000 and change, and then they're going to accrue the interest on that as well. So from the client standpoint, what they're funding the policy out of pocket is partial premiums, again, here in years 6 through 10, and then we are paying off the bank loan in year 11. In this case, we're going to show the client start to draw down tax-free retirement income starting at age 65, which is in year 12, and we draw that all the way down through age 95, and the policy endows at age 120. Now, what's interesting, if you look down here, the total premium that went into the policy was $5 million. The client is funding a little over $1.2 million of that $5 million premium, and that is in the form of partial premiums here in years 6 through 10. Again, that was the net value that we drew down from the IRA. So if we look at the ratio between the total premium and the premium actually paid out of pocket, the client's contributing about 25% of the total premium. They're borrowing 75%, and then they're accruing the interest on that borrowed premium. So the question becomes, is the client better off doing this regarding net income drawdowns for retirement, or are they better off keeping that $1.5 million growing in that traditional IRA? Let's take a look at the comparison here. So if we look in the blue section here, this is the $1.5 million IRA, and we are assuming that is growing tax deferred, so no taxes on the gains. And when they start to draw income down, we are going to assume that same 45.17% top tier income tax bracket. So in the traditional IRA, when they start to draw down the same $194,000 and change that they're drawing down from the hybrid premium financing model, we see here that by age 73, those drawdowns draw the account down to zero, again at age 73, only 20 years in. Whereas in the hybrid premium financing model, they're able to draw that income down between age 65 and age 95, and then again, the policy endows at age 120. On the right-hand side of the screen, we show the dashed green line as the net cash value of the policy over time. The blue line is the net after-tax value of the IRA over time. Again, we see here it gets drawn down to zero by the 20th year. And then the thick solid green line represents the net death benefit of the hybrid premium finance life insurance policy. So whether they're looking at this as a legacy play, what they're going to pass on to generation 2, or if they're looking at this as a personal retirement income play, the hybrid premium finance life insurance policy really does outperform that traditional IRA, assuming the same rate of return or gross rate of return in both assets. And then we also run this report here, which shows that the traditional IRA would have to earn a gross return of 10.92% to end up with the same income drawdowns and the same ending value at just shy of $3.5 million, just as there's just shy of $3.5 million in cash surrender value in a life insurance policy. So again, we're talking about almost having to get double the return in the IRA compared to the life insurance policy. Life insurance policy, we're using an index credit assumption of 6.44%. And again, to get the same final outcome in the traditional IRA, they would have had to earn a 10.92% return as opposed to just 6.44. Okay, the second case study we're going to look at here, this is a female age 63. And she has an IRA value of $2.4 million. In her case, she did not need the IRA funds for income. This was purely a legacy play. Her total combined net worth was under the estate tax threshold, so she's not so worried about estate taxes, but the kids would have had to pay ordinary income tax on inheriting their mother's IRA value. So what we did here is assume, again, a 6% annual growth rate of the IRA, all tax deferred. we want to know how much we can pull down from that IRA to end up with a zero value after 10 years. And that reverse calculation showed that she could draw down $307,000 in change each year for a period of 10 years to draw that account down to zero, again, assuming it was growing at 6% per year. And based on this particular client's income level, we're using a top tier income tax rate of 32.05%. So if she were to draw down $307,000 in gross income from her IRA, she would obviously have to pay income taxes on that. And then so she would net $209,000 in change to fund the life insurance policy. So this is the budget that we're going to use to fund one of our loan models. We call this third year financing, where the financing doesn't start until year 3. So here's the ledger here. In column 1, we see a $209,000 premium, non-financed, in years 1 and 2. And then financing starts in year 3. So the premium jumps up 4x, so it jumps up to $836,000. The client continues to fund the same $209,000 in premium, or partial premium now. And then they're going to borrow $627,000 of the remaining premium, and then they're going to accrue the interest here. So again, the client is going to continue to pay that same $209,000 a year for 10 years. Again, that's the net drawdown income from the IRA. And then we're going to pay off the bank loan in policy year 11 here. So again, in this particular case, this was not a retirement income play. What we're going to compare here is the net death benefit of this policy funded in this manner compared to the net value of the IRA once the kids inherit it and pay the income taxes. So in column 14, this value here is the death benefit net of loans, again, net of the premium financing loan and net of the carrier loan once we pay off the third-party lender, the bank. And let's go ahead and take a look at the comparison here. So in the blue section here, this is the full $2.4 million staying in the IRA, assuming the same 6.44% gross return. Again, there are no estate taxes due down here because the client's net worth is under that threshold. And there are no taxes on the gains along the way because this is a qualified fund, right? This is a traditional IRA. And we're going to assume income taxes when generation 2 cashes in that IRA. So if we look at the value here in the blue column versus the value in the green column, which is the death benefit, if the client were to die, say in the first 22 years, that would put her at age 84. If you look at the graph on the right-hand side, the solid green line is what we're looking at here as the net death benefit. And the blue line here is the after-tax IRA value once generation 2 inherits it after they pay the income taxes. It hits kind of a break-even point here right around year 21, 22. And then the life insurance policy death benefit continues to increase because corridor has been met and the cash surrender value is pushing that death benefit up far beyond the net value of the traditional IRA. So really, in any of these years, in the first 20 or so years here, all the way up until the client is in their early 80s, and then in their mid 80s and beyond, generation 2 of this particular client is going to be far better off regarding after-tax value that they're inheriting. So again, dramatic difference between just leaving the money in the traditional IRA versus converting this into a semi-premium finance life insurance policy. So think of this as almost like a Roth conversion, but you're not converting it to a Roth, right? You're converting it to a life insurance policy. And this would be the case in both case study number 1 that we looked at today and this particular case study number 2. So the concept is, again, instead of rolling the entire lump sum over like you would into a Roth IRA, you're taking annual drawdowns from that traditional IRA, paying the taxes, taking the net value, and then deploying that into premium financing to maximize that total net return. So I hope you enjoyed today's webinar. If you have clients that are considering doing a Roth conversion, then we should definitely talk, because chances are one of these new strategies that I just showed you will yield a much better outcome for your client. And as always, we have the mathematics to run those apples to apples comparisons so the client can see transparently which strategy yields them a better return. So I look forward to seeing you again soon. I am hosting several live in-person premium financing boot camps this year, in the year 2025. I'm hosting one at Pacific Life's headquarters in Newport Beach, California, and then another one at National Life Group's headquarters in Montpelier, Vermont. And I'm also speaking at several other events, including Forum 400 in San Antonio, Texas, the Wealth Engineering Conference in Orlando, AEG's partner meeting in Cabo, FFR's symposium in Laguna Beach, ERT's Academy in San Diego, and several others. And by the way, if I did not mention your organization that I'm speaking at one of your events, please don't take offense. I just kind of rambled off a handful of them that I know I'm speaking at. So if you would like to take a look at my calendar of events, you can also go to lionsmarkcapital.com and click on upcoming events, and you'll see when and where I'm speaking. Okay, so I'm Darren Sugiyama, CEO and founder of Lionsmark Capital, signing off here, and I wish you and your family a happy and prosperous new year for 2025. God bless.